The stock market just dropped 10% in 2 days. And while that's painful, what's really going to impact our success is what we do in response to this. And that's why I want to share with you today the best article I've ever found on how to respond to scary days like this. And frankly, it's the article is helpful, and frankly, financial advisors during this period of time can add a lot of value to their clients by helping them think rationally during scary periods. I've been a financial advisor for over 20 years. I've had hundreds of these phone calls, and I want to share some of the insights that I shared with my clients. And I want to start first with this article by Vanguard because, frankly, it's excellent. Let's jump in. Okay, this is first. I want to talk about CNBC, and they just report that the Dow dropped 2,200 points on Friday, and the S&P lost 10% in 2 days as Trump's tariff market rout deepens. And they talk about the Nasdaq having dropped 22% since its market high in December, which puts it in a bear market. Okay, here's the Vanguard report that I mentioned, and it's titled What to Do When Markets Drop. Now, I've read a lot of articles like this. This is by far the best one that I've seen. And certainly, I think most advisors would say it's in the top 10% of these types of articles. So the article starts off, what to do when markets drop. Bear markets and corrections are a part of life. And unfortunately, if you want the upside, we got to take these downsides. And they say keeping a long-term focus is key. They go on to say there's been 12 bear markets in global equity since 1980, but history has shown that equities typically post strong results over the long term. So this goes back to 1980. You can see those 12 bear markets. It's each of these gray areas here. And some of these that were very scary at the time, like the COVID transition here. I'm sorry, it's back here. It almost looks like a blip, right? This section here, that's the COVID. But when we were going through it, it was really, really painful. In fact, that was the most rapid drop the stock market had ever seen. The S&P 500 was down, I believe, 30% in just 4 weeks. Okay, the article goes on to say dramatic market losses can sting, but recoveries typically follow. Bull market surges have been longer and stronger than the bear markets that preceded them. This is a really important chart, this one right here. And this is basically that previous chart shown in a different way. And here what they did is they show relatively how short the bear markets are versus the bull markets that follow. So you can see in the 1990s, here was a correction here. This, I believe, was the dot-com bubble burst. Now that lasted several years. And then this here is the great financial crisis. You can see that lasted pretty long. And then here's COVID. I mean, it literally is just that one streak down. But the important thing is time in the market has historically, and I do need to say there's no guarantees that this is always going to happen. But, for a long, long time, going back over 100 years, the stock market recovers. Companies continue to work to do things better, faster, and cheaper. Okay, so this chart here, I want you to bookmark it. I want you to take a screenshot of it. I want you to keep it in mind because as painful as all of these periods are, you can see they pale in comparison to the run up, both the width, how long it lasts, but also the amplitude, how far up it can go. You can see this bull market here. It was a 3x. People got a 300% return. And then, what did they pay for it? They paid this little dip down here. Now, really, they prepaid for it. This was in the 80s. This was the late 80s. This period here was painful. Okay, the Morningstar article goes on to say, we don't know precisely when a recession might start, but what we do know is that they end. I should mention that bull markets typically do not die of old age, right? Strong times in the economy don't die because they've been going on for 10 years. They typically get murdered. They typically get killed by something happening, something external. The great financial crisis was really brought on when people were no longer willing to buy those junk bonds that were backed by people's mortgages that frankly were underqualified or not qualified at all. Um, COVID, right? That was a nice run of the bull market until COVID happened. And that bull market was killed by COVID. It didn't die because it had been in existence for a decade. Okay, but the important thing here is equity prices, this statement here, equity prices typically start to recover before recessions run their course. So the market tends to recover before the all clear signal is given. And a lot of us are tempted, and people will say, hey, Azul, why don't I just go on the sidelines and wait it out? And then when it feels better, I'll get into the market. Now, this isn't financial advice. Um, I don't know your situation, but what I do know is Morningstar has a great chart on this. Let's keep working. They say timing the market is futile. I agree. The best and worst trading days often happen next to each other. And if you miss out on just, the 10 best trading days in a decade, it significantly impacts your long-term results. This is probably the best advice in this article. Don't panic during market turmoil. Investors who have overreacted to market events by moving to cash, what I was just talking about, have seen their portfolios underperform the markets, and long periods spent out of the market make matters even worse. So this is a really key chart, and this says what happens if you move out of the market. If you put your cash into the market when the market is going down, this is saying there's a 74% chance that you're going to underperform the market, and you're going to underperform by about 4 percentage points. If you're 6 months in cash, this is saying 71% of the time you're going to underperform what you could have done if you just stayed in the market. And this is saying if you stayed out of the market for 12 months, almost 90% of the time, 87% of the time, you would have been better off sticking it out, staying in the market. Now, I don't know what's going to happen. I'm not telling you what to do. I'm not saying you should or should not move into cash, but know that the odds are dramatically against you. And most of us have a balanced account. And Vanguard goes on to say that balanced portfolios of stocks and bonds have proven resilient. The longer you hold a balanced portfolio, the more likely you are to experience positive performance. This upper chart here is what percent of the time both stocks and bonds have been down over a 1 month period. You can see that's about 15%. 3 months, it drops down to about 10%, 9.6%. But look at this, for over a 3-year period, over a 5-year period, since 1976, investors have never encountered a 3-year span of losses in both stocks and bonds. It doesn't mean your account's not going to be down, but one of those, either the stock or bond portion, is going to have helped you out during that period of time, because over a 3-year span, over a 5-year span, one of those was positive while the other one was negative. Okay, and this is showing the same thing, showing what percent of the time a 60-40% portfolio has been down. So you can see almost a third of the time, the portfolio of 60% stocks and 40% bonds have been down. But the odds are still in your favor, right? That means over, 65% of the time, 2/3 of the time, it's been positive. And then if you go out 1 year, a 60-40 portfolio has only been negative over a 1-year span, 15.4%. Over a 3-year span, only 8%. And over a 5-year span, you have less than a 1% likelihood of a balanced portfolio being down over a 5-year span. And then these are the steps to avoid overreacting. There's several steps. The first one is to tune out the noise. Sometimes the best thing you can do is just don't look. And I know that ignorance is not bliss, but it can give you relief, because what typically causes people to blow out of the market is their sense of worrying amplifies to the point it becomes angst. and you can't sleep, and after 2 nights, 3 nights, several weeks of not sleeping, people say, I just want the pain to stop. But if you just tune out the noise, if you quit watching for a period of time, that can give you some relief from some of that angst. Okay, the next thing is to revisit your asset allocation. This is a really key point. If market corrections are making you lose sleep, it might be time for you to reevaluate your risk tolerance. Now, you will have already experienced the pain and the loss from your current asset allocation, but this is definitely a time, and this is definitely a signal that, you know what, your asset allocation is likely too aggressive if you can't sleep at night, if it's rising to angst, if it's really causing a deep temptation to want to sell out of the market. Okay, the next one is to control what you can, and that's cost. Expenses erode your returns. This is particularly painful when the stock market's correcting. The next one is to set realistic expectations. Historically, the market's delivered attractive returns, but unfortunately it doesn't do that year after year. And then stay diversified. They say, Vanguard says, a great way to insulate your portfolio is have exposures to stocks, bonds, international markets in an asset allocation plan that makes sense for your risk tolerance and goals. And bonds can act as ballast. They can buffer things out during downturns because hopefully they're not down as much as the stocks. And really, hopefully they stay, they maintain their value or maybe even go up in value. Vanguard goes on to say international exposure can give you access to markets that may generate positive performance when others are falling. Now, the thing I'll add, and we're seeing it now, is it's called correlation breakdown, where when scary things happen, even though different asset classes are not supposed to be correlated, it oftentimes it tends like there's nowhere to hide. Everything goes down. So, what do I think? What I think is what you do to protect yourself is what you have done 3 years ago, 5 years ago to protect yourself, which is that getting that asset allocation right. Now, if you're feeling angst, if you're feeling pain, you are where you are, but that's a really valuable data point for you to know that maybe your current asset allocation is too aggressive, because the goal is to be able to make good decisions, thoughtful decisions, deliberate decisions, even when scary things are happening. And if you like making good decisions, if you like my videos where I talk about this, consider watching this video up here, which the YouTube algorithm says is the perfect video specifically for you to watch next. Thanks for watching this one.